Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Ask 10 different people and you'll likely get 10 different opinions about the outlook for property prices. But one thing is clear. Even with the recent downturn, growth in house prices in recent years, even recent decades, has been pretty remarkable. So much so that many young people now find themselves priced out of the market. Add in a rental crisis with surging immigration and soaring rents, and the situation looks a little dire. Evan Thornley is an Australian entrepreneur with a long track record of success, founding one of the first Australian tech companies to achieve a NASDAQ listing and unicorn status, and then starting the world's largest early childhood education provider. Among many other roles, he also co-founded activist network Get Up and been a politician as well. Evan's now co-founder and executive chair of Longview, a residential property business that is setting up a shared equity fund to help owner-occupiers get into the market. Evan Thornley, welcome to Fear and Greed.
Thanks very much, Sean. Good to be with you.
So let's just talk about the market generally before we get to Longview. What's your take on the market? We've obviously seen a blip in price rises over the past 12 months. Is it something that you think can be sustainable? Can we keep a lid on prices? Do they revert? How do you see the big picture with the Australian housing market?
Yeah, look, I think the big picture is a good point, right? And look, Longview and PEXA, the electronic conveyancing giant, just published a series of white papers to try and add some clarity and factual basis for this conversation because, you know, gallons of ink are spilt every day on the question of house prices and what drives them. And frankly, most of it is just wrong. It actually misunderstands the drivers. So what I think the data conclusively proves is that over the medium and long term, house prices in Australia have gone up about 7% per annum. That means they double every 10 years for 80 years. Through interest rate cycles going up and down, through different tax policies, through a whole lot of other things that are usually seen as the drivers of house prices. But the things that have consistently stayed the same over that time and are therefore the principal driver of house prices in the long term is very simple. We have the second highest population growth rate in the world. And that surprises a lot of people. We have a much higher population growth rate than even, say, somewhere like the United States, certainly than all of Europe, or even obviously China, which has actually reached peak population, or India, or a whole lot of other places. And that surprises people. But that's a key driver. And related to that, more than half our population live in just 3 cities. And so what that means is the competition for land in the suburbs of Australia's big cities just continues to get greater and greater and has done since before any of us were born. And so whilst things like interest rates or negative gearing or Chinese money or supply side issues all have an impact, I'm not saying they don't, it's just that it's about 1/10 as much impact as the long-term impact of population competition for scarce suburban land.
And you can't see that changing. I mean, that's been going for 80 years. So obviously there's a fair argument that there's plenty of momentum in that. But is there a point where it just gets too expensive to live in those 3 cities, which Sydney, Melbourne, Brisbane, presumably, and they can't build any more buildings and so you kind of get to a tipping point, or are we a long way from that?
Unfortunately, in a lot of ways, we're a long way from that, right? Australia's cities are still relatively undense, right, compared to Manhattan or the West End of London or many, many other places you can imagine, which have even higher house prices, right? Yeah. You know, everybody talks about house prices and their relationship to people's incomes, and obviously that's important. But I think what most people don't understand is that if you look at the total housing market, it's more about people's wealth than their incomes. You know, early stage home buyers, obviously they need to borrow most of the money to buy the home. And I'll come back to them because that's where the real challenge is for early stage home buyers. But if you look at the housing market as a whole, 5 out of 6 home buyers are not first home buyers, right? And the entire housing market has only got 23% debt on it. Whilst an early stage home buyer might get 80 or 85% debt, when you look at the whole house market, it's only 23% debt. The other 77% is equity. That's wealth. It's not driven by income, or it's certainly not today's income. It may have been driven by previous year's income. So the whole housing market is really the wealth sink of the economy. Everybody would like to live in a better home, and when they have more money, they buy a better home, and the value of that home goes up, and then they have more money. So whilst it's really critical to understand what's making it so hard for first home buyers to get in and getting harder it's also important to understand that the factors that have driven the overall market are not changing and are going to continue. And so there's no reason to believe, unless Australia's fundamental approach to population changes, and no one on either side of politics is arguing for that because it's so central to our economy, we are going to continue to see the scarce value of suburban land driving prices further and further up.
Is what's happening at the moment in rental prices and a surge in immigration and that, it's presumably that's just like a spike in a longer story. Is that right?
Well, that's right. And let's separate rental affordability, which is also really important, but a different question to purchase affordability.
Yeah.
Right. And driven by different things. Rental affordability is driven by the supply and demand for dwellings. Purchase affordability is mainly driven by the supply and demand for land. And note to self, there is no more supply, right? So the demand gets the prices up. So in rental, the essential problem we've had is we are having population flooding back into the country and new stuff is not coming out of the ground. And this is leading to a generational crisis in rental vacancy rates and therefore rental prices. And nothing anyone is going to do in the short term, to be honest, is going to change that. There's nothing governments can do to wave a magic wand tomorrow to suddenly get more stock out there that isn't built. So it's really troubling.
Stay with me, Evan. We'll be back in a minute. My guest this morning is Evan Thornley, co-founder and executive chair of Longview. Okay, I want to bring it back to first home buyers because you mentioned them. How do we get first home buyers into the market?
Well, let's also look at that over 100 years, right? Because what's happened is the gap between house prices and people's incomes has been widening for 100 years. So how have we changed the way we bought houses? Look, our great-grandparents in most cases couldn't buy a home, but if they could, it was because they literally saved money and bought it with their savings, paid cash for it.
Yeah.
Our grandparents, you saw the beginnings of widespread availability of home mortgages. So they saved everything they could and then they got a mortgage for a portion of it. Maybe it was a 20-year mortgage, maybe on a 60% LVR, and that's how they bridged the gap as the gap was getting wider. Our parents' generation got 75 or 80% mortgages and started bringing a second income to service them, and that's how they bridged the even bigger gap. My generation have had 80, 85, 90% mortgages, 30-year mortgages, lender's mortgage insurance, and that's how we bridge the gap to an even wider gap. The fifth generation, you've kind of squeezed that mortgage finance as far as you can squeeze it. You need third-party equity. You need more equity from someone, and that's what's happening. The bank of mum and dad, as we all call it, is the fifth biggest home financier in the country now. So huge amounts of equity are now adding to the purchasing power of first home buyers. Governments are now putting money into shared equity schemes, and then companies like Longview and a number of others are bringing private shared equity schemes to market because the fifth generation of housing finance, to bridge that ever-widening gap between house prices and incomes, is going to be relying on more equity, and it's got to come from somewhere. And if you don't have access to the bank of mum and dad, then you need to either get it from the government or from a commercial provider.
Okay, what's this mean long term? So I appreciate that having a third party taking equity in an asset into a home, and then when that house is eventually sold, that third party gets their share of the pie. Does that long term take pressure off prices, or does it actually put more pressure on prices?
No, it certainly won't take pressure off prices. I'm sorry to say, but I wouldn't overstate its impact on prices either way. I mean, the numbers here are such telephone book numbers; it's hard to comprehend. You know, governments are going to put about $2 billion into shared equity over the next few years, up from nothing not long ago. That's a lot of money, but that's $2 billion. The entire housing market is worth $10,000 billion, $10 trillion, or probably about 9.5 right now. So don't think that it's going to make that much difference. Again, all of these factors do impact pricing a little bit, but the overwhelming factor that impacts pricing is population and population growth.
So this is a Dorothy Dixer, Evan Thornley, co-founder and executive chair of Longview. However, is it the best answer? It's not obviously not the only answer, but is it the best answer, this shared equity model?
Well, it's kind of emerging as the only answer, to be honest. I mean, if you include, when I say third-party equity, mainly right now it's the bank of mum and dad, right? But increasingly then it'll be shared equity. If you don't have bank of mum and dad, then you'll need to get that equity either from the government or from a commercial provider. And that is emerging as the dominant answer. There are methods to rent to buy. They're tricky, particularly in Australia, because rental yields are so low in Australia. So sort of adding more to the rent doesn't get you that much closer to the purchase. Very different to, say, the US. Australia is one of the strongest capital growth markets in the world, but that means it's one of the worst rental yield markets in the world from an investment point of view. So you've kind of got to swim with the tide of the economics and focus on how you get access to that capital growth. Lots of parts of America, for example, instead of 3% rental yields, they'll have 8, 9, 10% rental yields. And so things like rent to buy are much easier to work in Cleveland or Houston or Atlanta than they ever will be in Sydney, Melbourne or Brisbane.
But a relatively safe investment in Australia.
An incredibly safe investment. I mean, there's so much commentary about, is it the right time in the cycle? As if we're betting on the stock market. The stock market every 10 or 15 years crashes, as you know, and drops 40 to 70%, often virtually overnight. People talk about bubbles and crashes in the housing market. The Australian housing market has crashed once. That was in 1893. Okay? We've just had the biggest proportionate rise in interest rates in the fastest time in history in the last few months. And how much of Australian house prices gone down? About 9%, right? Having gone up 20, right? Yeah. If you look at it over an 80-year period, it's extraordinarily non-volatile. It's an incredibly safe asset class. And if the dominant driver is population growth and that population growth continues, then you keep seeing that reflected in continuing rising land prices and therefore continuing rising property prices, depending on how much of the land content is in that property. So high-rise apartments have virtually no capital growth and they're terrible investments. Detached homes in good locations have really strong land content, so have really good capital growth.
Evan, so much to unpack in that, but we're out of time. Thank you very much for talking to Fear and Greed.
Thanks very much, Sean.
That was Evan Thornley, co-founder and executive chair of Longview. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.